Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a real estate investor, advisor, and coach, as well as the founder of Streamlined Properties and the team leader of Streamlined Properties on Market, brokered by eXp Realty. Whether you are looking to start from scratch, get to the next level, or just a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Let's go. We're back with another episode of Zen and the Art of Real Estate Investing. Thank you, as always, for being here. I really appreciate it. Got a great show for you, and it's a little bit different than your standard show. This is about wealth creation and innovative wealth strategies, Delaware Statutory Trusts, 1031 exchanges, triple net leases. It's going to have a little bit for everybody. Can't wait for you to hear it. The guest is Frank Hanna Jr. Stay tuned, and while you're at it, share your favorite episode with a friend. That's my ask for you this week. Let's get to the show. This is episode 91 of Zen and the Art of Real Estate Investing with my guest, Frank Hanna Jr. Frank is the founder of Revolution Exchange. He leads a team that provides comprehensive analysis, tailored programs, and turnkey solutions for tax-free exchanges. They are very focused on real estate investors as a wealth management company. He also has a history in real estate. Frank, welcome to the show.
Thanks for having me, Jonathan.
Yeah, it's a pleasure. Let's start where we have definitely a shared background. Your dad was a multifamily investor. Tell me the first thing that you remember about being involved in real estate.
Yeah, so kind of grew up around real estate. Didn't really understand it at first. He was,
Same.
Yeah, I saw it going on. A lot was happening, good, bad, and different. But yeah, he started in the restaurant business and actually had some success there and took some of his first years of success in capital and started investing in real estate. He began with a single family home, rented it out. And I think beyond his financing and his repairs and maintenance, I think he said he was putting about $100 in his pocket per month.
That's good at the time.
Yeah, that might have been 50 years ago. But that was exciting to him. And he said that was pretty big money back then. But he ultimately started there, started accumulating more rentals, and then started building some of his own communities and really kind of got his start in multifamily, mostly single family rentals.
Yeah, it's interesting, too, to think of both of our parents, because I grew up in a similar way that there was no internet then. Things were way different. To acquire properties was so much different. You couldn't look at all the pictures on Zillow, and access wasn't as easy. Do you remember the first time that you started to look at real estate through him and say this is pretty cool? Yeah,
no, I could see. I would go to his office and he would show me, the books and the accounting side of it. And then I would also tag along to him when he would start getting calls in the middle of the night to go deal with problems. So I saw some of the exciting sides of it, but also some of the stuff that, was not as appealing. But started learning a lot probably in my, early teens on the multifamily side of things. And then he started to kind of evolve into different asset classes from there.
Yeah, it was similar for me. I used to go on all the rent pickups. And then as I got old enough at 18, I started doing collections. And I was like, well, this isn't that fun. I just want the money. Yeah. So he would say well, if you get the rent collected, they'd be 6 months behind. You can keep this percentage. And I was like, all right, this sounds good.
Yeah, sounds good.
Yeah, parents have a way of doing that. What age were you when you first decided hey, real estate's going to be at least an interest of mine? Because I know you went into different businesses before you got there, fully involved in real estate and financial management.
Yeah, I would say as an early teen, I knew this was something I wanted to incorporate into whatever full-time career. I didn't necessarily know if it was going to be a full-time thing for me, but I saw the value of passive income and I saw that type of accumulate. And he always taught us a lot about tax planning. So we were able to, kind of use that to, take our portfolio to the next level. But yeah, I would say mid-teens, I kind of started to look at that. And we went from single family homes, construction, And he ultimately did a lot of 1031 exchanges. He bought a couple pieces of farmland and we ended up exchanging out of that. And I think the multifamily community, as we kind of had it set up, which was all of our team kind of hands-on management, got very labor intensive. So we ended up selling most of our single family home and parlaying that kind of into some triple net lease type properties with some single tenants and also some, I'd say essential retail shopping centers, that type of thing.
Yeah. I mean, and as far as passive income goes, triple net leases are pretty solid in that regard, right?
Yeah. I mean, you get the financial strength, assuming you've got a quality tenant in there.
Yeah.
And being able to kind of hand off, the triple net piece of it and let them take care of the, property taxes, repairs and maintenance and insurance stuff allows you more flexibility and more security and enhanced cash flow typically.
Yeah. Yeah. I mean, less upkeep because the tenant's really in charge of everything.
Yeah, exactly.
Yeah. I mean, I guess for anybody who may not know, can you just go over what a triple net lease is and why it's attractive as an investment portal for anyone who's looking for cash flow and maybe a little bit more hands off on the business?
Yeah. So the triple net means that, the single tenant in place is responsible for those three pieces. So upkeeping, repairs and maintenance, insurance, property taxes. So if you've got a really strong tenant in place there, not only are they responsible for all those pieces, but, the theoretical, bomb could blow up that location and 7-Eleven or whoever you have is responsible for any issues there. And as long as the lease is structured the right way, 7-Eleven corporate or whoever the entity is responsible for that lease. So we've had a lot of, situations where we kind of lean on those stories over time. And we've had locations fall out of favor, but because we've got the backing of that really strong tenant, we never missed a beat with rent collections.
Yeah. So, I mean, triple net's really like, I guess, a dichotomy of location and the tenant. I mean, obviously, like when I think of triple net, I don't know why I just think of CVS because that's solid. Fast food's obviously a big triple net, but, things can adjust along the way with those. But that's what mainly people are thinking of, these chains that are around that don't want to buy all their own properties for all these hundreds of thousands of locations.
Yeah, perfect example. So we started with one location. I think we bought a 7-Eleven in Coral Springs, Florida, which we actually still own. That was probably 35 years ago.
Yeah,
and
I've probably been there. I lived in Fort Lauderdale for 7 years.
Okay,
yeah.
you probably have. But yeah, we built that to about 45 locations, I'd say up and down the East Coast, which are, 7-Elevens, Wawa, Sheetz, Royal Farms, got a few McDonald's, that type of thing.
Yeah.
But yeah, good tenants and that financial security of that tenant is pretty nice.
Yeah, I think people and investors in general, when they look around and they see all these businesses, they kind of disregard what's underlying that, which is land.
Yep. Yeah.
So as a triple net leaseholder, you own the land and they're responsible for everything else. Are there any real potential losses in a triple net other than losing the big tenant?
Yeah, so I'd say that's it. The risk there is that you get out towards the end of that lease and that location would fall out of favor. And if that tenant decides to walk and your location is not as attractive as it was when you purchased it, there is some risk there. But I think, again, diversification comes into play and being flexible and negotiable with your leases. So we're coming up on leases coming due in this kind of hyperinflationary and, this challenging interest rate market. We've had to have some tough conversations, not always ideal circumstances. But at the end of the day, if you've got the right tenant and the right location, you can strike a deal that makes sense for both parties.
Yeah, that'll still be profitable, maybe just not at the same level.
Yeah, it all depends, but we've done well with them over the years.
Yeah, I mean, I guess triple net's interesting because it's like a little bit harder to find. It's not something that's as easy. Obviously, on the commercial sites like CoStar, you can find triple net. Yep. But for you, as someone who runs financial and wealth management firm, that it's a good option for people who don't have a lot of time, who do want to invest and get very solid passive returns with businesses that are unlikely to go out of business, right?
Yeah, absolutely. So a good litmus test that we kind of looked at was like going through COVID, right? So we invest in so many different asset classes and some of them did suffer
Yeah.
But that essential retail was probably the strongest, where again, they were allowed to stay in business. And
I mean, what was stronger than CVS's during the pandemic?
Yeah, you got
there was nothing on the shelves, but I mean,
yeah, exactly. So you were still going in there searching for COVID tests.
Yeah.
But yeah, so they performed really well. And I think, again, depending on, where you're at the stage of the game in terms of a real estate investor, that asset class is really appealing to certain investors.
Yeah. And that goes to diversification too, which we talked about briefly. I mean, when you're looking at, because I know from dealing with just general like financial managers over the years, they're a little bit not into real estate. But when you come into wealth management with real estate as an asset class that you like to use, you can diversify within real estate as a whole, because there's so many different types of assets that can deliver income and also suit a client's needs for maybe what they like for other investments, right?
Yeah, absolutely. So I think diversification, you hear that word all the time, and I think that goes across not only just real estate, but all types of investments and assets that you have. One thing my father kind of told me, he started in the restaurant business, so he took a lot of substantial risk there, and then he got into real estate. But once he started to have success there and kind of compound that cash flow and expand those properties, he started to, divest into, tax-free municipal bonds and obviously had some money in the stock market. And, I think it's really important to have four legs to your chair. So, at one point in time, one piece of business or asset class is going to, have issues. And I think that's where, that diversification is critical. And when we're giving financial advice to anybody, most of our investors have, assets in real estate, and a large portion of their wealth is in real estate, but we always want them to have, true diversification outside of just all brick and mortar, real estate, or all one asset class, or all assets in one geographic area.
Yeah, I mean, one of the most important things for you guys to do in the wealth management is to really evaluate all the assets and get a full accounting of what it is, whether it be cars, which can be depreciated, art, which is a huge thing that people don't talk about as an investment. I was in the art world for a long time. Huge investment with opportunity to actually scale your own portfolio in a similar way to real estate that people don't expect.
Yeah.
Those are things you want to look at so that when you recommend real estate, you can balance that against the other assets that they already have, right?
Yeah, absolutely. There's so many good features to, like, some of the things you just mentioned, and then taxes, right? It's not what you make, but what you keep. So there's a lot of favorable tax breaks within the tax code for investors in real estate. And a lot of people don't truly understand that. So a big part of being able to, compound wealth in real estate is, through being able to depreciate assets. And we do a lot of those kind of C-store gas stations where you can do cost segregation studies and you fast forward all that depreciation and save, a massive amount of money in, the first or second year within those deals with the investment. And we do that now, Jonathan. So we've kind of taken a lot of our lessons learned and some of the things that we've put together, as kind of a blueprint for success. But we also understand that it takes a lot of capital to really, get to those high quality assets. So we've kind of taken our kind of blueprint and put together, diversified portfolios in a variety of those asset classes. Some are designed for accelerated depreciation in the forms of those convenience store gas stations. So we package those deals. And we have investors that can invest in those deals and get access to high quality real estate for as little as, $25,000 or $50,000. So we have a lot of people that come to us that want to invest in real estate. They just don't know where to start.
Yeah, but you have access to inventory as well through what you've done. So that kind of provides that opportunity that maybe the other just regular financial advisors don't have, because you're connected to the industry and have these opportunity properties that you can place for clients. Yeah,
exactly. So we've got really good relationships with some of the big real estate players in the country, and often can secure off-market deals and again do a lot of the heavy lifting to be able to package that and get beyond the due diligence phase and offer that to investors that are looking to just get in the game but don't know where to start.
Yeah, I mean, this brings up a lot of things, because I think, like, if I look at my career, I never had like a full team on board. I was always like moving pieces and, move a financial advisor around. And then before I was licensed, I'd have one good agent that I didn't like, and then you're switching it around. But what you guys are doing is trying to kind of work all together so that you can help somebody maximize. And the only way to do that is to know really what their goals are and then what their other assets are. So you can really, like we were saying, put diversified pieces is so you don't have putting in the same thing. I mean, it's cool to do multifamily, but I don't think, I personally don't want to be like all in one asset class either, just because I get bored.
Yeah, no, I like, every year I think a new asset class comes to the forefront that I get hot on. But we do a lot multifamily, self-storage, student housing, triple net lease, industrial, a lot of different stuff that I think have good storylines behind it. And if you give, somebody the menu of options and advantages and disadvantages, they can kind of come in and say, hey, you know what? I like that. I don't like that. And, they can get a confident start.
Yeah, I really like industrial too. I think industrial is an underserved asset class for a lot of people who don't know. It's cheaper
Absolutely.
to build. It's similar to self-storage in a way where you're not going to have a ton of bathrooms and tenants. It's going to be much bigger, and the spaces have become completely multifunctional.
Yeah, absolutely.
They're not. It's not just like tractor storage anymore. I mean, there's businesses in industrial parks now that create this kind of like off the beaten path vibe.
Yeah, the run on e-commerce and the death of the traditional shopping mall have created such demand, and you just can't. The demand for that space is so huge that the rate in which they've been able to raise rents has been unprecedented, and you can't just build or drop one of those massive industrial centers just anywhere. So it's a good storyline. I think that's going to be a good asset class for the foreseeable future.
I think so. I mean, completely built for everything that's e-commerce, which is all trending there. No reason to have a storefront when you're good on Instagram and you're selling everything.
Yeah, exactly.
You can just like have a cool warehouse that costs like 1/5 and you get 5 times the space.
Absolutely. I love it.
Yeah. So, I mean, if someone comes to you and they have no real estate in their portfolio, but they have a balanced, stock bond portfolio, is there an asset class? I know it would be based on their interests, but if it's just say they had kind of general, is there an asset class right now that you would recommend since it's such an odd time for investing that you think it would be solid right now?
Yeah. So I'd say with this kind of hyperinflationary environment, right, it's been, hey, how can you keep pace with that? And the longer term lease type stuff that may be industrial or maybe triple net lease has probably felt the effects on paper in terms of the value, right? And the assets that were able to adjust their rents either daily, like self-storage or hotels, or monthly or annually, like multifamily, have been able to kind of keep pace and raise values. So I think I like multifamily a lot. I like self-storage because it's an asset class that kind of performs well in a good and bad economic environment.
I agree.
Right?
Yeah.
If things are going well, you're going to buy toys, you're going to move around, you're going to store stuff. And if things get dark, you're going to sell the big fancy house and you're not going to get rid of all the stuff you've accumulated.
Yeah.
So we do that. A lot of times we'll do the student housing community and then get a self-storage right next door to be able to kind of capture both of those relationships and double dip in the income.
Yeah, I agree on self-storage. I mean, it seems to be completely recession-proof to me, especially if your placement is good in an area. You can't really lose. Like you said, people are going to downsize. They downsize the house, not their stuff. The golf clubs just don't fit in the house anymore, so you put them in storage and pick them up along the way.
And it's very sticky. People just stay and stay.
Yeah. Because from a landlord's point of view, it's so much different than multifamily, and it's not really actual tenants. It's just stuff. And if they don't pay, you just change the code.
Yeah, exactly. Yeah.
What are you going to do?
Take their stuff and sell it.
Yeah. And that's fairly passive as it goes if you just have like one building manager, and a lot of people who have multiple or just have one kind of virtual manager managing a few spots because you don't need anyone there for entry most of the time anymore.
Yeah, it's very lean from an operational standpoint. So we've been doing a lot. I'd say we've really started, self-storage over the last like 4 or 5 years is something we've gotten active, and we probably own, 15 properties, but I feel like we'll keep growing that.
Yeah, I think one huge benefit on self-storage when you're buying is also there's a lot out there, mom and pops, that have extra space for adding more units, and that's where the huge value add is on those.
Yeah, adding more units, and you get operators that, it requires a little bit of, maintenance and upkeep. And you see a lot of people that are those assets that are underperforming. So we'll find primetime locations and maybe somebody's just not marketing appropriately. And we'll come in and, think we will steal the asset and then run it the right way, get it set up, and then it kind of is on autopilot.
Yeah, I think you can tell no marketing, dirty, like that's always right.
Yeah, exactly.
Because it's so easy to change it over. You know why their, occupancy level is low. It's just because they're not trying at all.
Yeah, absolutely. Yep.
Hey, it's Jonathan. This is just a brief interlude to talk to you about Deal Machine. Listen, I've used Deal Machine and I was crushing it with my Concerned Citizen postcard on Deal Machine. You can look that video up on my YouTube and find out how I did it. It works. Deal Machine works. I've had David Lecco, the CEO, on the podcast. So if you want a free trial of Deal Machine, the elite Driving for Dollars app, and I'm telling you, it works if you use it correctly, you can go to my link at bit.ly/Zen Deal Machine. Now, bit.ly is bit.ly/Zen Deal Machine. It's free and you'll be up and running in 2 minutes, and then you can figure out if you want to keep it. Let's get back to the show. Well, let's talk 1031 exchanges just for a little bit. I know it's popular. Everybody knows about it, but I feel like our parents were doing them before it was like a thing to talk about on TikTok.
Yep.
How's your dad and maybe you used 1031 exchanges to your advantage? And what are any drawbacks, if there are?
Yeah, so I'd say we've us as a group or family's probably done about 100 1031 exchanges, and most people may be aware in the real estate space, but it allows you to sell a piece of property, defer or not recognize any gain or loss in a property, and take those capital gains instead of paying the tax. You can roll that into new investment property. So I would say the number of clients I have that are ultra wealthy have just been doing that over and over. And it is that the running joke is defer, and then die with the asset, because you can get the step up in basis. Yeah, you can get the step up in basis. Your heirs or kids can inherit the asset and pay little to no tax on that. So that I think, the 1031 exchange has been around for 100 years. It's not a new tool. Some people don't understand how it works or have misconceptions on that. And then we started an arm of our business to help in that regard for clients that are selling real estate. And I think, it's not necessarily something that, the younger generation is looking at or evaluating. You get a lot of people in real estate that are buying, fixing up, and flipping. So it's they're not really a candidate for it. But I think the statistic is there's 10,000 people every day that are turning 65. So the generational wealth of those baby boomers that are moving into retirement and are completely over the excitement of property management is unprecedented. So we do a lot of 1031 exchange consulting. We also, so again, we're completely independent and agnostic. We get a lot of clients that are your hands-on real estate professional that want to own, touch, control assets, and we can guide them to really good solutions. But for a lot of people that are kind of over that excitement of property managing, the tenants and the toilets and the taxes, we've put together a proprietary passive investment platform that puts together Delaware Statutory Trusts programs that are a solution, again, that's not new, but a lot of people are unaware that they're out there and how they could be a solution for their next 1031 exchange.
Yeah. Before we get to the DSTs, I just want to say, I think like my misconception with 1031, and I did a couple when I was younger, well, it's because I was relying on just myself to find the properties. So I was identifying 3 and then kind of stuck with them. But now with 1031s, a lot of intermediaries or assisters like yourself has a pocket of properties that are good switches. Like you're matching what the values are. You have the connections to be able to move properties in where you can kind of plan it and it's all going to work out. Whereas instead of just identifying 3 properties and hoping they stay on the market in a tough market.
Yeah, it's a challenging time with interest rates and against inventory, but I think with internet and qualified resources, whether it be somebody like you or me or anybody that's out there, you can get access to a lot of different types of assets. And I think, if you've got a good intermediary and you've got a good team of people, you can kind of plug and play to make those numbers work to match up your equity and your debt, and hopefully find at least a handful of options to be able to identify to give you some flexibility and hopefully close on at least one of them.
Yeah, I love the idea though of starting like a 1031, snowball for like your kid when they're very young, and that's how a lot of people do it to, produce a college fund. But like, because then it allows you to know like, hey, I can trade the asset when it's hot.
Yep.
Market's hot for multifamily. Let me trade it. Yep. Upgrade on a 1031 into something else and just keep rolling the ball till the end.
Yeah, no, it's exciting, and I think people don't always understand that how big taxes come into play, and you don't necessarily want the tax tail to wag the dog and just buy something to avoid the tax. But if you do it systematically and find the right asset and you have some systems in place, the ability to defer that tax over a lifetime is transformational.
Yeah. All right. Let's talk Delaware Statutory Trust, because I've heard of them. Like I probably heard of them from my dad. I know they exist, but explain to us what they are and then how you incorporate them into helping someone grow a portfolio or investment.
Sure. So the Delaware Statutory Trust, or DST, which is the acronym, have been around for decades. They've evolved over time, but they essentially are the only passive real estate option that meets the 1031 exchange criteria. So the way I describe them is they're a prepackaged, professionally managed portfolio of assets that allows you to invest and receive a fractional ownership in this overall trust, which owns, again, anywhere from 1 to, I'd say, a dozen or 2 dozen high-class institutional assets, again, that allows you to do a complete tax-deferred exchange and, again, do the same effect as a traditional exchange. A lot of people like them because you give up the headaches of property management.
Yeah.
You still get a lot of the benefits from a tax perspective in the form of pass-through depreciation. You can take deductions for amortization of loans. So you get a lot of those benefits. You get a monthly tax-favored income that's still pretty attractive. And you also have the opportunity for like upside appreciation on the asset. The one kind of caveat that some people get stuck up on is, hey, I can't control the asset. I can't make decisions on it, meaning that it's a relatively illiquid asset. So it's not something that you can invest in. And John, you can call me next year and say, hey, you know what? I found a better deal. I want my money back. It's definitely something that, is invested in brick and mortar. But again, that's where it kind of comes back to diversification. Typically, you can invest a small amount in these. So whether it's a first option or a complementary option to like a piece of hard real estate, or just a backup plan if something falls through, we encourage layering out multiple investments in the Delaware Statutory Trust. So it almost becomes like a laddered bond portfolio, where once you get out to year 3 or year 4 and beyond, it's very common for us to reach out to our investors and say, hey, good news, one of your deals is going full cycle. We're going to sell it. Whether you like it or not. And here's your overall return. You have all the same choices that you had when you went into that. Do you want to cash out, pay your taxes? You can do another Delaware Statutory Trust with us or somebody else, or you can actually go back into hard real estate. So, you kind of mentioned this before, but this has been a interesting time, right? So real estate values are still at a premium. People are saying, hey, you know what? I'd like to sell out right now and capture that premium, but I don't necessarily want to go pay top dollar somewhere else.
Exactly.
Just to avoid the taxes. So we're seeing a lot of people that are selling their real estate and looking to kind of park their money in some shorter term Delaware Statutory Trust, just as a landing spot to hang on to their basis and reevaluate the market in a few years and say, hey, you know what? Now things have kind of corrected themselves. I'm excited to go back out and find hard real estate. And then they take that opportunity to kind of go back and do that.
Yeah, I mean, that seems like the ideal thing to use for right now. Prices are still high for sellers, especially if they have an asset that's appreciated so much and still has high value for others. But like, yeah, you don't want to go in and buy something, using some DSCR loan or just burning your cash when you can wait a couple of years and it'll cost 20% less.
Yeah, exactly. And the higher financing costs are a shock to people, right? You're paying off your deal and you're paying off your cheap mortgage at the settlement table, and then
Exactly.
and you realize, oh, I got to go out and get another loan.
Yeah.
And the bank that already doesn't want to talk to you is going to give you a loan at 7 or 8%. And when you crunch the numbers on your new deal, it just doesn't make sense. So we get a lot of people that get that reality check and come scrambling to us to look at DSTs as as a replacement option for either the whole deal or just the debt, because we've got better, more favorable financing that people can use to make the numbers work.
Yeah, I mean, it makes sense. I don't know why anybody is like, oh, I don't know where the inventory is. The inventory is in the rates. Why would somebody sell at a 2.75? Because then they're going to have to buy at a 7.5. It's just, it's hard to swallow unless like you have to do it.
Yeah, it is. And a lot of people get too far along down the road and then take that consideration.
Yeah. So moving forward, like, are there any asset classes that you're interested in that weren't really popular a couple of years ago that you think now, like, oh, that's something? I know we talked about industrial, but is there any others as, someone who's managing a lot for people that looks interesting to you?
Yeah, I'd say, it's kind of a caveat of multifamily, but we like single family rentals, which is kind of back to where I started with when we first started this call. But some people are saying, hey, you know what? I like the idea of multifamily, but I'd like a lawn. I'd like a little space. I'd like to be able to walk my dog out my front door and not have to take an elevator. Yeah. So we're doing a lot of deals like that. Student housing, again, is big. We do a lot of student housing deals at big name colleges, I'd say SEC type schools down south where students were allowed to go to school during COVID. And those communities are popular. But believe it or not, like hospitality, I'd say specifically hotels in the right market are something we like. I feel like they got hit hard during COVID, obviously, because nobody was traveling. And I don't feel like their value has gotten quite back to what it was before that. So we're seeing some really good hotel deals where we're getting prices at a really favorable terms. We feel like there's some good upside there. So that's an asset class that, some people have strong opinions about. You either love it or scared of it. But I think that's an asset class that has, it just hasn't quite come back to where it was before. But I think it's headed that way quickly.
Yeah, I really like the smallish motel type of situation now, because I feel like those operators are just spent. If you have a mom and pop motel, like whatever, 6 to like 13, 14 units, that's ripe for some type of short-term conversion with short-term, mid-term, maybe some long-term. So, the more units you have, you can diversify within that and get all different streams of income coming in.
Yeah, absolutely. I think so we do a lot with those kind of boutique or smaller motel kind of where we'll come in and just, spend the money it needs to kind of bring it up to par. But we do a lot with your big kind of flagship hotels too. So your Marriott's, Hilton, Hyatt. So those operators, a lot of them are in distress, and banks don't want to lend to them. So we've actually got some partners where we do some lending there. And we also have experience in that space. So again, we think there's some good opportunities to own those assets. And a lot of those operators are just, again, worn out, tired. They've got a lot of loans maturing. And and we're one of the only games in town that'll lend to them. So we'll lend at a favorable loan to value. And a lot of times we'll end up taking them out at a really favorable price for us and managing the asset ourselves.
Yeah. When you look back were you in wealth management in 2008, or did you start after that?
I kind of started right as that was happening. So I was running our restaurants for a long period of time and realized I wanted to get out of that. And as the world was kind of crumbling, I was managing real estate for us. Yeah. But I just was kind of getting into wealth management. So I managed to dodge that storm as an advisor, but was kind of coming in at the very end of that. So That's about when I started was 08, 09.
But when you look back at either clients and also, of course, your dad and then other clients, how they manage like 2008 versus like pandemic versus like oddity of mortgage rates, what's like a success principle overall where you see like your most successful investors? What are they doing where other people are failing?
Just do not panic. You cannot let panic drive any of your decisions. And there's clients that I have or relationships that I had that jumped out of the market at the bottom of the market in 08, 09.
Yeah.
And never got back in. They can never come to grips with getting back in. So again, that's where you can't let panic dictate how you're investing in anything. Keep your capital working for you, keep reinvesting. If it's in the stock market, find a way monthly, quarterly, annually to reinvest dollars. It's sad to say, but from when the market corrects, I feel for my investors because I know they look at their portfolios and get concerned, but I get excited as an investor to say, hey, it's a buying opportunity. You always, when everybody's going one way, you go the other. And if you can kind of invest with that iron gut, philosophy and keep your dollars working, do not panic. Things will eventually come back and stay diversified. So you don't want to be all in the stock market. You don't want to be 100% in real estate. Just, spread things around. Interest rates are coming back. So, bonds are getting a little bit more favorable after, being on the outs for a while.
Yeah. Yeah, I think that's great advice. I mean, I think if I look back at my journey, I panicked after 2008 because I just got scared. So I just started hoarding cash, which was great. I had a lot of cash, but I didn't do anything with it for way too many years because I was too scared I was going to lose it. Yeah. So putting it all in a bedroom doesn't really work for your long-term gain. And I think now I applied those principles to pandemic and sold, like you said, and stockpile for now. I probably should have done some 1031, but I didn't like the prices of what I would have to buy. So DST would have been a good option at the time.
Yeah, we all make mistakes, and I've done the same thing. And a lot of that is from doing the same thing. There was times where I panicked and made decisions but 9 out of 10 times they were always the wrong decision, and ultimately I would have been better off just staying the course.
Yeah. For somebody who's doing very well in their job, they make a bunch of money, but they haven't really leveraged investing at all. What would you tell them to get started just as an overall wealth philosophy? Just someone who is doing what I just said, they're hoarding their money now, but they have too much money and they need to start to put it into things carefully.
Yeah. Well, I would say, start by looking at your business. So you've got your business, right? And you're taking risk there and you're taking risk as a business owner. But if you're not capitalizing on the opportunities as a business owner, so that could be looking at retirement plan options, simple stuff, simple plans, SEPs, 401k with profit sharing, cash balance pension plans. There's a lot of plans out there that will allow you to contribute a lot of money towards your family, your key employees, and tax deduct it. It can be a really attractive, attraction tool for new employees or a retention tool for existing quality employees.
Yeah.
That's somewhere a lot of people we see are not paying themselves as much as they should. They're paying more in taxes. They don't have those plans in place to take advantage. It's not always the best fit. The more rank and file employees you have, the more cost prohibitive it gets, and you have to take care of everybody fairly. But for the right type of companies, we do a lot of cash balance pension plans for husband and wife owners that have not a ton of employees. I'd say 20 or less, and in a lot of cases, when the census data makes sense, they can contribute 400, 500, 600,000 and tax deduct it, and 90 to 95% goes to the husband and wife. So again, I think it all starts with the tax side of things. But as far as just basic investing, cost matters, simple index funds, I tell everybody, including my kids, look at your budget, start small. Can you put in $50, $100, $500,000 a month into an account and invest in a low cost, index fund, get those dollars working for you. Roth IRAs, I'm a big fan of those. There's a lot of simple stuff, and it's not as sexy as going to talk about some institutional real estate purchase, but it's basic. You'll wake up in 5 years and be like, wow, I have a lot of money. I had to do it with myself. I was scared to death to start a plan to really sock away money.
Yeah.
And you blink and 2 years go by and you've got all that money that I know I would have spent on something stupid in my checking account.
Yeah, but that goes to not, what you said before about don't panic and patience, which everyone said like, hey, what were you doing the last couple of years investing? I'm like, not much, just being patient and selling stuff. Cause I don't like bad deals. So I have no like force to myself to buy, for my own income. I just can wait it out. But yeah, I think that's good advice, especially for anybody at any level who's feeling like compelled. There's so many different types of investments, ones that can be smarter for the long term, where you don't have to put everything into a Roth IRA. You can just smartly use it to your advantage. Yeah.
Now there's all different types of investment strategies, and some of those different types of accounts with different tax treatments, are right for different things. But yeah, I think just keeping your money working for you, systematically investing in an account that can be liquid, don't chase deals, don't chase bad deals. But, if you keep your dollars working for you, the right deal will come along and you'll wake up and have a little pot of money there on the sidelines that you can utilize for it.
Yeah. And then you can just do it again with another little pot of money and make it a bigger pot.
Yeah, exactly.
Yeah. Awesome. All right. Frank, where is the best place for people to get in touch with you guys? Is it at revxwealth.com?
Yes. Yep. So that's our website. There's forums on there if you want to, sign in, ask questions, request a call, a meeting, webinar, Zoom. Happy to talk. No strings attached. Answer questions. Confident you'd get value out of a brief conversation with us.
Yeah. Awesome, man. Well, it was a pleasure.
Thanks.
That was a great episode.
Overdue.
Yeah. No, I'm glad we got it knocked out. But I love episodes that go down a little bit of a different path. And this is great, for the listeners to get that. The DSTs haven't come up. Now I get it more. And I'm like, I could have used those so many times in the past. Yep. But now I won't forget. So I appreciate your time, man. Thanks so much.
Worries. Yeah. Good luck to you, man. Let's keep talking, and happy to keep following you, and good luck to you.
Yeah, man. Look forward to staying in touch. That was Frank Hanna Jr. of RevXwealth.com. I'm Jonathan Green. We'll see you next week. I hope you enjoyed that episode of Zen and the Art of Real Estate Investing with me, Jonathan Green. And I just want to remind you, and this is always an uncomfortable part, I don't want you to think that I'm begging for you to like, subscribe, follow, do whatever you have to do for the podcast, leave a 5-star review. But if you like the podcast and you think it adds value in the real estate investing sphere, then just do me a personal favor. Like the podcast, follow it, share it when you can with your friends, and be so kind as to write a 5-star review if you believe it deserves a 5-star review up against what else is out there. I would really appreciate it, and I hope you keep listening.